Hi and welcome to yet another episode of Sustainability with Sasja. And here we have the man himself. Welcome, Sasja.
Thank you very much.
How are you doing?
Very well. And what about you?
I'm doing fine, thank you. So the topic today is the fossil fuel industry and the renewable energy market. And in 2011, a report by the London-based think tank Carbon Tracker highlighted the risk of fossil fuel investments becoming stranded assets, since we had already exceeded the world's carbon budget by 2011. However, and last month, Carbon Tracker released a new report showing quite surprising numbers. Since 2000, there had been over 2,000 new IPOs in coal, gas and oil. However, investors have lost billions on these investments, and instead the winners could be found in the renewable energy market. Let's see what Mark had to say about this. In your first report published 2011, you examined the threat of fossil fuel assets becoming stranded assets as the shift to a low carbon economy accelerates. Can you please tell us about the main findings from the report?
Yes, so the report, when we published it, we simply took the world's top 200 listed coal, oil and gas companies. We then looked at their reserves and resources, calculated within a reasonable degree of probability the carbon dioxide is embedded in those reserves, and then asked what would happen if all those reserves got produced and burnt. And the answer was enough to take the world to 3-4 degrees of warming. It was quite a startling result, but not startling for the readers and for the investment community, but for the scientists and the academics. It just confirmed what we already know, which is the world has far more fossil fuels than we can possibly burn.
So back in 2011, you calculated the global carbon budget and compared that to the total carbon potential of the Earth's known fossil fuel reserves. And numbers show that back in 2011, we had already exceeded the world's carbon budget by 180 gigatons carbon dioxide. Where are we today? Is it too late?
Yeah, it's never too late. So let's be optimistic, but we're running things very tight. So at the moment, the world is emitting somewhere around 40 gigatons of carbon dioxide, which is one of the principal warming gases. And I mean, some give it as a little bit higher than that, but we think it's around 40-ish gigatons. And then the remaining carbon budget, depending on who you ask, is somewhere between 300 and 500 gigatons. The reason why it's a range is there's obviously uncertainty, but also there's probabilities. So if you have a higher probability of, say, avoiding 1.5 degrees of warming, which is the upper limit, if you remember, of what the scientists suggest is where we should be putting a cap, then maybe you're only at around 200 to 300 gigatons. So based on our calculations, we estimate that there's something like 8 or 9 years left before we will have put the CO2 in the atmosphere associated with a 1.5 degrees level of warming. We're heading to there now from observation of warming. Doesn't mean that it will always stay there, because there's some variation, seasonal variations, but we'll expect that creates the conditions for 1.5. And then about another 10 or 15 years after that, based on the same emissions, if we don't flatten emissions, then we'll head past 2 degrees. And then maybe another 10, 15 years after that, 3 degrees. And to put that into context, we've got the highest concentrations of carbon dioxide in the atmosphere that we've seen for 400,000 years. And we'll get to a level of warming which is unprecedented in near history, of which humans have been, around 20,000, 30,000 years. So we haven't even seen these levels of warming for many hundreds of thousands of years. That's why London, which, as I'm sitting in London, is not an unpleasant place to be. You know, at 3-4 degrees of warming, London was a steamy swamp. If you go back underneath London, you find alligators and you find swamp and you find exotic animals. It was just a very different environment. That's where we'll be heading back to if we don't cap emissions as soon as we can.
And in the report, you highlighted the importance of finance to tackle the climate crisis. And last month, you published a new report which showed that exchanges are still listing new fossil fuel companies to raise capital aimed at expanding production or developing new reserves. But if we want to follow this 1.5-degree consistent pathway, we need to decrease fossil fuel production by roughly 6% between 2020 and 2030. Do you think that we will be able to reach this goal?
Yeah, well, we have to actually reduce it something like 6% per annum. So it's a very high task. The good news is that renewable energy is available. The potential for renewable energy, sunlight and wind, is available everywhere around the world in far higher quantities than actually fossil fuels are. The challenge we face now is, can we capture it and can we turn it into useful things like electricity? And the technology revolution that we've seen means that renewable energy is now cheaper in most parts of the world than fossil fuels, and that's exciting. So, it's cheaper to close down existing coal-fired power and replace it with renewables in many parts of the world today. That may surprise a lot of people. So that's the good news. The bad news is that policymakers and decision makers and investors are taking a little bit too much time to catch up. What we need is a clean $1 trillion a year invested in renewable energy technologies, low carbon technologies around the world, and that really needs to have happened, now. And that what we're finding is, whilst we're winning the technological battles, we still need to see this huge shift of capital. So our first report really was a call to, firstly, to investors, time to move your money, and secondly, to regulators who regulate things like stock exchanges and banking systems, to say, let's create financial markets that are properly regulated for climate outcomes. And so we were very surprised that, as the report you mentioned, we learned from it that there's been over 2,000 coal, oil and gas IPOs, initial public offerings, on stock exchanges around the world in the last 10 years that raised over 600 billion. And on top of that, you've got the trillions of dollars lent through the banking system. So this is just the equity markets, the shares that people may own in their pension fund. That isn't so great. And it wasn't such a good decision. And as you know, that investors lost around half of their money if you bought those oil IPOs or coal IPOs. The reverse with renewables. You would have done very well indeed if you bought a renewable energy portfolio in the last 5 years. So we're heading in the right direction. The challenge is, can we move fast enough, and can regulators catch up with what needs to be done?
Yes, and since 2016, we have, as you mentioned, seen that equity investors have been moving away from fossil fuel producers. Can you please talk a little bit more about this recent development?
Yeah, so as investors have woken up to the fact that what's driving the transition in energy markets is not just so much climate policy, but technology. Clean technology is getting cheaper, more reliable, and more widespread as people switch to electric vehicles or to solar and wind. And as a result, investors have been selling their shares in oil and gas and coal. Some have been divesting for what you might call moral reasons. Many have been divesting for purely financial reasons. And instead, they've been turning their portfolios to invest in clean technologies and renewables. I mean, the big trade of 2019 and 2020 was essentially sell Exxon, buy Tesla. And if you'd done that, you would have done exceptionally well indeed, as Exxon's valuation collapsed. And as we know, Tesla's valuation went through the roof. And that just tells a broader story, that what investors know and the public know is this clean technology revolution is happening all over the world, and they're trying to pick stocks. Tesla's just perhaps the best known one. Companies like Ørsted are better known in the Nordics. And fund managers and the retail investor are just trying to pick their way through who they think might be winners. It could be electric vehicles, it could be solar technologies, it could be hydrogen, or it could be the minerals that are used to go into electric batteries. There's a lot of interest now in trying to find the green winners of the 2020s.
Thank you very much, Mark, for joining me today from London. So that was Mark Cabanelli from Carbon Tracker. Sasja, what are your thoughts about what Mark just said?
Mark and Carbon Tracker are doing a fantastic work. I mean, he's taking up a couple of things that are really interesting. One is that the financial industry is still late to the moment where we are right now in terms of the shifting the capital flows from what is regarded as old fossil-driven economy to what is regarded as sustainable future type of economy. The volumes of investments that we need for this transition are still not there, which indicates that there's a lot of talk, a lot of words, but not as much action as we would like to see. The number of IPOs tells you that there are a number of investors out there that still believe that supporting the old type of economy will contribute to better returns or returns back to themselves and their clients. Apparently the case is that they lost a lot of money, which also indicates that you will probably, within a couple of years see a huger shift that you have today. But what worries me is that in the research that is done by Carbon Tracker, and Mark indicated that in the beginning, is that they looked at 200 publicly listed companies, but you have to bear in mind that about approximately 90% of fossil reserves around the world are owned by national states, sovereign states. And that's not a part of the calculation that is done by Carbon Tracker, which in other sort of a view would mean that our situation is even more dire in terms of the outcomes. Yeah.
But it seems like some things are moving in the right direction because renewable energy is becoming cheaper and cheaper, and we have advanced the necessary technology. However, like you mentioned, capital flows are still going into non-sustainable businesses. What needs to be done to change this?
I mean, technology shift is one thing, but we need volumes and we need speed. I mean, the most sort of a natural way of doing this would be that we continue transforming the fossil industry into sustainable, shifting the capital flows and also investing in technology. However, we know that we, for some foreseeable future, will need to invest in fossil infrastructure because we need it, because we are dependent on it. And it also means that in the same time while we do that, we also need to invest huge amounts of volumes of money into renewable energy development, especially in the countries that have a huge population. And if you look at, for instance, at urbanization or parts of the world where the urban cities will go, mega cities will go in the future, that's not in Europe, that's not in North America, it's mainly in Africa and Asia. That's where we need the scalable solutions that will lead to the results that we actually, all of us, expect to see.
We have regulations that are supposed to, or frameworks that are supposed to regulate this. For example, we have the Paris Agreement, and there in Article 2.1c, it says that financial flows needs to be aligned with a climate-friendly development. So why aren't we seeing this happening?
Bear in mind that both in Paris and also in Copenhagen before, the financial sector has not as a sector received any particular targets to take down the CO2 emissions generated through lending and investment activities. This is something that was discussed further on after agreement has been concluded, because most of the politicians then understood and realized that they needed financial industries to support this change. So I think what we need is a far more transparent view on how financial industry is investing and lending today, much better information, more transparent information. We need a policy in place, not only in the European Union, but also in the US and Asia, where we can shift capital flows, really long-term shift, where the sustainability, and in this particular case, climate is one of the key issues to see and look in the way how we invest going forward. And it needs to also be clear that most of the people around the world do not necessarily understand that whatever they do in a symbolic way with their sort of a, driving less car or not taking the flight, eating more sort of a organic food or not so much meat, compared to the fact that their pension money right now, right here, 24/7, throughout the year, are invested maybe, and in many cases, yes, in the companies around the world that have huge CO2 emissions, and that these people actually own, and this is what Mark was saying, they own that in their pension money and this in their savings, and they don't necessarily understand that.
Exactly. Is this something that you think that the public aren't aware of?
No, they are definitely not aware of that. And most, then you can see that especially in Sweden. I mean, there was a couple of weeks ago where many of the ministers in the government were pointed out as not understanding what their money is invested, and especially on the environmental side. And there were a number of ministers that had holdings in the companies that are heavy CO2 polluters without, with them being representatives for environmental party and being in the government. So that tells you a bit how little people understand consistency around this. This is a systemic issue. Financial industry needs to shift the flows. We need a policy, instruments, we need transparency. People need to understand how you can use the tools of the financial industry to do that.
So what about the EU taxonomy? Do you think that's going to be enough to have a real change?
I think EU taxonomy is a first step of many steps. You have the latest discussion now where the nuclear energy is now classified as renewable because you had a fight between France and Germany mostly on how to classify that. Parts of the gas is also identified as renewable. I think what you can see is the compromise within the EU that goes back to what these countries are dependent on in their own economies to sort of try to mold the way forward. It's a first step. I don't think we are there. There were a number of people that participated as advisors to this EU technical group that resigned as the fact that they are not supporting the classification that is going to be presented. So I think it's a first step. We are moving. But the problem we have, and that goes back to the financial industry, to policy level, and to EU taxonomy, is that we are too late. We don't have this time. And what you can see now is that you have the push from the public to shift from fossil energy. In a normal times, we would have maybe 10, 15 years to do that, to phase it out. What we have now is that we know we need to invest in renewables a huge amounts of money, and we need to cut what we invest in fossil sort of types of energy as soon as possible. And these two equations are not easy to sort of handle.
Is this mission impossible we have in front of us?
Look, I'm optimistic. As Mark, I'm optimistic. I think we can do it. But I think what we need is that we need these capital flows, especially I would say from US and Asia. Europe is more or less through the SFDR, through the EU taxonomy. We are moving into this space, but we need the capital flows from big markets to shift into this space.
Mark did mention that the investors that followed the IPOs of oil and gas, they actually lost around $123 billion in value, and they underperformed the world index by 52%, while renewable energy market outperformed by 54%. Do you think that this trend will continue?
Look, in the financial industry, numbers tells you everything. So, I mean, when you lose so much money that many investors have lost, I think what they are trying to do now is to see if, one, to evaluate if the increase of investments in renewable energy, the scale, technology, will lead to better returns. There is a bit of an overvaluation in this industry as well, because everybody's running into it right now. So you would see many stocks, I think, on the listed side that are maybe a bit overvalued because there is such a huge interest, not so many of them. But I think the trend is quite clear. The fossil industry and the heavy CO2 emitting industry will have harder and harder to capitalize themselves, to find investors that will like to invest in them. And by doing, I mean, in that case, they will have much harder to perform in a way that you would expect them on the market.
And as a competitor to the oil and gas industry, we have electrical vehicles. And another report by Carbon Tracker said that these companies have probably underestimated how much sale there's going to be in the electric vehicle industry, and that the price of oil will have peaked by 2027 and continue to go in a downward spiral. Do you think that this is going to be the case?
Well, oil prices are dependent on so many other geopolitical issues as well, so it's hard to say it's going to peak out. I think it's as Mark indicated, only on the listed equity side you have enough reserves to continue emitting for a long period of time, and of course that will also impact the prices of oil. On the other hand, I think we are under or overestimating a capacity of the world to produce electrical vehicles at the scale giving the energy use we have to support use of electrical vehicles right now is heavily tilted towards still fossil industry. So even if you shift the entire fleets to electrical vehicles, you still need to solve the issue of energy supply On the other hand, and that's something that I think in many cases people don't understand, electric vehicles are just consequences of us shifting the energy support models that we have.
And one of the biggest electrical vehicle retailers is Tesla.
Yes.
And I know that you had a look at how sustainable Tesla really is. Tell us, what did you find?
Well, I looked at the Tesla business model and the man behind Tesla. As in many other cases, the entrepreneurs of the caliber of Elon Musk and others are the people that are inventing the new ideas, but also constructing the new business models. It's extremely interesting business models as such. Of course, it has a potential, but on the other hand, I'm very concerned about the fact that in normal Tesla, for instance, today, you have about between, I think, 15 to 20 kilograms of cobalt, which is extracted from DRC, Democratic Republic of Congo. Of course, Tesla is now trying to shift towards more nickel. Nickel's biggest producers are Norilsk Nickel in Russia and some other places, not so sustainable either. I think Tesla as a business model is very interesting. How scalable it is, I think it's a question from both, I think, technology perspective, but also the price perspective, given they are still very expensive. If we think about supply of the business model, being that materials and resources they extract from the countries that are in a very complex environments and they have a lot of challenges to tackle. And just bear in mind, this is not addressed by automotive industry at all today. Yes, there are a lot of initiatives on the ground in Congo, but there are very few concrete actions that including Volvos and Volkswagens and BMWs, that they are trying to do this, but it's a very few concrete things that have been done on the ground to address one of the biggest challenges, which is child labor related, environmental pollution, corruption, and so on.
As Mark said at the end of the interview, there is a lot of interest now in trying to find the green winners of the 2020s. In what industry or market do you see
usually
winners?
Usually you will go directly to renewable energy. What I will do is to take a step back and see the component suppliers to some of these industries. Equinix is one of the companies that I've looked at.
What do they do?
Equinix is providing the energy saving solutions for data centers around the world. It has 20 different kinds of outlets around the world. It's providing, I think, 98% of the energy they actually use for the savings is renewable. So the business model is really interesting. And that's one of the companies that is really showing how this could be done.
And you had another one called Aptiv.
Aptiv is working, it's also the component provider in automotive industry that is helping companies, both I would say on a commercial and business vehicle side, to provide components on energy saving and safety sort of improvements, which are very, very energy smart and also climate smart. I think the business models, latest I looked in this forward-looking climate trajectory we have, is on 2 degrees. So it means it's really sort of looking at the way how they can continue growing the scale of their business and in the same time stay on the path that is to Paris and be the business model of the future.
We have seen lots of interest in the renewable energy market since mostly during the last year, 2020, and also it continues today. We have seen Vestas, Etrion, Cell Impact, and so on.
And what we need is a scale. We need a speed and scale. That's what we need.
Yes, that's what we need. Well, Sasja, thank you very much for being here today. And thanks to you guys for watching. We're going to be back in 2 weeks' time.